As earning week continues, we are drawing your attention today to AbbVie, which did report before the market opened only a few hours ago. Now, they did report some very strong earnings, and we can see they are down around 4%. So we're going to take a look at exactly why this is. We're going to look at their earnings in detail, also discuss their forward guidance, which they did update, as well as do our usual analysis looking at both the revenue growth, top line, as well as bottom line net income. We want to see the health of this company, their total cash versus their total debt, as well as looking at not just their dividend safety, but also analyze a lot of forward-looking metrics like the free cash flow, the ROIC, as well as understand both insiders as well as institutions, whether they have been buying or selling. And we'll also look in today's episode at some details from their press release, as well as their long-term pipeline guidance, which they did update just a couple of months ago. Now, as always, we are going to run it through the valuation model so we can get to the intrinsic value, get to our acceptable buy price with the margin of safety, and look towards Wall Street to see what they're forecasting for the next 12 months. Now, just a quick update on the S&P 500. We can see there is quite a lot of green today with the market open, although the majority of this is coming from the likes of Google, who did report their earnings very strong, as well as the announcement of a dividend, as well as we can see Nvidia up 5.16%. Now, when we take a specific look at the healthcare sector, we can see AbbVie is down, in fact the worst performing today, negative 3.86%, with the others in the healthcare looking fairly flat, although we can see Eli Lilly up 1.34%. So let's take a look at their earnings. Let's see what the numbers say, whether or not this is anything to worry about for shareholders and for potential shareholders, or in actual fact, there is some very strong signs and potential undervaluation. So what we can see is they reported quarterly earnings per share 231. Nice to note it did beat analyst estimates of 226, although when we do compare this to a year ago, they did have a slightly higher earnings per share at 246. Now, what we can see here is over the last 4 quarters, they have beaten on their earnings per share quarter over quarter, so that is a positive sign. And when we take a look at their revenue, they reported 12.31 billion, and we can see analysts had targeted lower, so they did in fact beat the estimate by 2.65%. On top of that, they also beat for the same quarter last year 12.23, so we do see marginally higher. And also similar to their earnings per share, AbbVie is a company that not only beats their earnings per share over the last year in 4 quarters, but also we can see the very same trend with their revenue, which is a very good sign. Now, when we take a look at the company, we can see over the last 10 years, if you have been a shareholder, you would be up 215%. This would be slightly higher if you do incorporate those dividends reinvested. When we take a look, however, over just the last year, you would be down around 2%. Now, we do know after today's drop, they are in the midpoint of the 52-week range. The forward yield is at 3.71%, and the forward P fairly low at 15 if you compare it to the S&P, which is around 21. And we do have 2 buy ratings, one from Seeking Alpha Analysts and one from Wall Street for AbbVie Inc. Now, let's take a look at the numbers behind this company. How have they been progressing over the last 10 years? What we quite like to see, 3 to 7% growth as a very baseline number, at least 3 to 4 just to keep up in line with inflation. And what we know, they have more than doubled their top line from 20 billion in 2014 to 54 in December 2023, their latest annual account. So quite nice to know. Over the longer term, AbbVie are increasing their revenue, as we can see here. So this is a very positive trend. Essentially something you want to see in all companies every single year, growth to that top line. When we compare that to their bottom line net income, a little bit more inconsistent. 1.8 billion reported in 2014. 4.9 in 2023, and we can see in fact just from the previous 2 years that bottom line was much higher. So something just to incorporate with AbbVie, that their bottom line is very inconsistent, whereas when we did take a look at their top line revenue, we do see pretty much growth year on year, something we can factor into our investment thesis as well as our margin of safety. Now, when we take a look at the balance sheet, this is a very quick look at the health of the company. Total cash, short-term investments versus their total debt. 8.4 billion in December 14 12.8 from their latest quarterly report. So we do in fact see a small increase, or in fact a 50% increase, so not small at all over the period. But what we would say, pretty inconsistent. We do see it grow up to 2019 levels, and then it does come all the way down. So overall, in fact, if you were to remove the outlier, it is actually fairly consistent over the longer term. When we analyze their total debt numerically and directionally, what we see is significant growth from 15 billion to that latest quarterly report of 60.6. So over the longer term, with cash pretty much remaining fairly flat, their total debt is increasing, something we need to consider for their dividend safety, as well as looking at that net debt to EBITDA metric. What we quite like to do is look at a few of their growth grades, as well as essentially their profitability. On the growth, not great at all. We get a C+. Now, reason for this, their growth year on year, 6.44% negative, with the sector median coming in at 6.48 positive. When we look at a forward basis, pretty much flat into next year, we can see the average of the sector coming in at around 9.3. On top of that, a few other metrics looking very poor. One thing I do like to look at is this earnings per share over the next 3 to 5 years. On average, it is expected to grow at 8.5%, where we have the median with industry leaders at around 10.95. So we can see they are just lagging, not just on the earnings per share, but also on the growth gradings too. So something for the consideration. Remember, we'll implement this into our margin of safety. Profitability, well, much better. We're looking at the best grade obtainable at A+, so very strong. Gross profit margin, 69%, sector median, 56.83%, and the bottom line, very strong, 9%, whereas we see the median of the sector, in fact, having a negative bottom line. So, great sign for AbbVie. Whilst their growth does struggle, we do know their profitability is very strong and one of the best in the industry. As always, we will compare it to a few others in this industry. So we have the biotech companies like Amgen, like Vertex, and a few others that we have in fact reviewed on this channel not too long ago. Over the last year, if you were reinvesting those dividends, you would be up around 2%. Now, not the greatest return, let's be honest, for AbbVie over the period, but we do know in terms of comparison, it is in the middle of these industry leaders. When we extend it to the last 5 years, 153%. In fact, the second best or third best, just behind REGN as well as Moderna at 307%. When we go further to the last 10 years, what we do know, again, it is towards the top three there at 376%. So very strong when you do zoom out, but again, past performance is not an indicator of future performance, so always factor that in. And we also note there are others in this industry that have performed a lot better, like VRTX, as well as Moderna and REGN not doing too bad. So industry as a whole isn't that bad unless you were an investor of Gilead Sciences over the last 10 years. Now, what are the insiders doing? Well, insider ownership, 0.25%. We see 8 different sellings by these insiders amounting to 71 million over the last 12 months, with essentially the majority of this coming in Q1 of 2024, so not long ago. When we take a look to see who these insiders are, well, we in fact see 2 different sales in March for around 80,000 shares, and we do see quite a significant amount, nearly $14 million. So it's something just to consider, insider selling. Whether or not you believe it's a bullish or bearish signal, you can make your own mind up, but you can see there has been quite a number of sales by different insiders, including the CEO at the bottom there on the 28th of February. When we take a look at institutional ownership, well, just over 70%, 9.83 billion worth of sales by the institutions, and we note here a lot more buying, 23.4 during the same period. Now, 2 things to note. Firstly, over 2023, every single quarter, we do see a lot more buying than selling by the institutions. However, the second thing to note is in the more recent quarter, we see double the amount of selling by the institutions than we see buying. So yes, over the last 12 months, on average, a lot more buying than selling. However, in the latest quarter, we actually see the opposite. So let's take a look at their earnings. Now, the main thing we wanted to draw out, as we have pretty much touched up on this throughout our discussions today, is the forward guidance. Now, what we can see here, very important, what they have actually done is raise their 2024 adjusted EPS guidance from 10.97 to 11.17 to 11.13 to 11.33. So effectively, the higher end of their previous guidance is now towards the lower end of their updated guidance, which is very positive. It does show strength to the market that whilst they have beat on their revenue as well as their earnings per share, which has now become typical with this company, they are also increasing their essentially earnings per share guidance. We also note as well they have successfully completed their acquisition of Immunogen as well and its flagship cancer therapy. So lots of positives to note with AbbVie, and now we can very briefly take a look at their long-term guidance as well as their pipeline update. Now, when we take a look at some of these slides, what we can see firstly on their longer term guidance, so this is going up to 2029, they are pretty much not just on track for a lot of these essential key performance indicators that they have, but they have also raised a lot of their guidance, so they expect it to be a lot better than what they had initially expected. And we can see this for both of these here. We have Skyrizi as well as Rinvoq, which is looking like it will be bringing in more sales than what they had expected. And as we can see, this from 2024 all the way to 2029. So they already have some very good indicators of how the business will perform. And as I mentioned, 3 of these they have in fact raised. And when we take a look at these 2, we can see the growth is expected to be very strong over the longer term. In fact, it is expected to go from 16 billion in the full year of 2024 to around 27 billion in the full year of 2027. So lots of growth, as it does say here. They do expect robust sales growth from both of them. In fact, they estimate this will continue into the 2030s. And what I always like to take a look at, now this isn't something that is in my field of specialty, but with any research and development pipeline, they have 3 different phases before we have that final submitted phase. And what we can see, there is a lot that they do have in the pipeline. In fact, in the registrational phase 3, which is towards the end, there is quite a number of different items which are going through the developments. So lots of positives to note. Whilst nothing has come out right now that is there to be discussed in today's episode, we can see just the momentum that they are having with these 2 products is looking very strong, not just into 2027, but also into the 2030s. Now, what we also want to let you know is that we have released our latest free weekly article. If you want to gain access to this or any of our other articles, click on the pinned comment below. You can start reading straight away. Access is instant and it is completely free. Now, in terms of AbbVie, the dividend safety score is 80. It does look to be safe. Market cap just under 300 billion. It is a mega cap company. Now, last recession, the data that we do have is that their sales was plus 10%, which was above the average growth of the S&P, which was in fact around negative 12. When we take a look at dividend growth, a little bit disappointing, I have to be honest, last October due to the fact that we want to see a minimum of 4% just to keep up in line with inflation. But what makes the 4.7 disappointing is that over the last 5 years we saw high single digit. Over the last 10 years we saw double digit growth. So I would like to think that in FY24 this October we do see a lot better increase to the dividend. And what we can note is they are a dividend king. They have increased those dividends for over 50 years whilst paying a dividend for 100 years without a reduction. As always, let's take a look at dividend yield theory. Now, for those that are new, it does state the company is undervalued when the current yield sits above the 5-year average. So, in fact, for AbbVie, we have an overvaluation signal. We also note the forward P does sit higher than the 5-year average, so a double overvaluation. But as always, bear in mind, we don't look at any of these models in isolation, and we will conclude towards the end. On top of that, what we do see here is that the healthcare sector P is significantly higher at 17.2, so AbbVie is currently trading much lower than that of the healthcare sector. When we look at free cash flow power, very important, remember, below 60% to give us that faith that management do offer those double-digit dividends we love to see, but biotechs, we do bring this down to 50%. Over the longer term, pretty much straddling around that, so no worries there. FY24 at 54% doesn't give any cause for concern, so all looking healthy and pretty consistent over the period. Free cash flow margins as well, I'm sure you've heard me say it before, we want to invest in companies with increasing free cash flows. Now, whilst it has increased over the longer term, not massively inconsistent, which is nice to note, but what we would say is FY24, they are expecting their free cash flow to drop slightly, so something just to consider. When we look at the sales growth, remember 3 to 7% is the bare minimum. What we can see actually over the longer term, it has been very strong, but the last 2 years have been fairly poor. 2022 right there at the lower end, 2023 with a negative 6% drop. So again, lots to consider for AbbVie, and remember we can impact these numbers into our margin of safety later on. So numerically, we can see more than doubled their sales as we discussed earlier. And unfortunately, whilst we like companies to return excess cash through share buybacks, over the longer term, we can see they would have diluted your position with the increase in shares, although we also note it isn't a massive amount either. ROIC with biotechs 25% or more. Remember, return on invested capital, it does give us faith that management are able to effectively allocate their capital. And what we can see here, double digits, very strong, around the 25% consistently. It does straddle around that for the majority, so it does look fairly healthy. Operating margin, very strong. We do see consistently above the minimum 25%, 33 in FY23. The same to said for the free cash flow, although what we know is it has been increasing over the longer term, so that is a very positive sign. We can note that AbbVie is in fact what I would call a free cash flow machine. Finally, the net debt to EBITDA, so this is the earnings before interest, tax, depreciation, amortization. And remember, these numbers are the years that it would take the company to pay off all of their debt net of cash on hand. Below 1.5 for biotechs. We do see it pretty much straddle a bit above that consistently over the longer term. And remember, this correlates to both dividend safety as well as balance sheet strength. So it is a little bit high. It is around that in FY24. I would like to see it come under, but it isn't a massive red flag indicator just yet. Something we can keep an eye on moving forward. As always, if you do enjoy the content and values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Let's jump into the first valuation model today for AbbVie. We're using the dividend discount model. Over the last few years, we have an average growth of 7.72%. Forward looking, we've gone pretty much conservative in our opinion, below the average and pretty much around what the latest increase was. When we take a look, based on this conservative, we get an undervaluation signal showing some very nice room for upside. But as always, bear in mind we don't look at any of these models in isolation and will conclude shortly. We then have the discounted cash flow model with the free cash flow growth year on year. Average growth rate 31%. Forward looking, we have gone for a lot more conservative at 2%. Discount rate 8%. We get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see here another undervaluation signal. So in today's episode, the intrinsic value is purely the average of these two models, and it does come to just over $200. In fact, both models do come to around a very similar amount. So the current price is $160. Margin of safety, as always, we do want to use 10% to execute. However, this is only if the stock meets the 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So at 10%, we see a buy up to 180, and then we keep going till it's near the current trading price. And for today's episode, we pretty much see a bang on 20% MOS level. In terms of Wall Street and their forecast over the next 12 months, Wall Street see upside of 16% with a price target of $186. So in conclusion, AbbVie a 20% MOS level, upside of 16%. And in terms of whether or not this is a buy, Wall Street, as we mentioned earlier, do see this as a fairly decent buy. They did double beat, which is expected as we have seen over the last 4 quarters, and they also raised their earnings per share guidance. Now, this is one that I do hold currently in the portfolio. However, it is a fairly full position, so I would only add to this if we do see a much larger margin of safety. By larger, I would be looking to enter around $440 at a 30% MOS level. But again, at 20%, I do still see there is some nice value here. This is a very strong company, but there are some key points that we do need to keep an eye on quarter on quarter. As always, let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.